Hi everyone, and welcome to another episode of Wine and Markets with Dan and Cam. I'm Dan, and I'm joined by Cam. And for today's podcast, I'll start with the disclaimer just to get it out of the way, as we usually do. So this podcast is for entertainment purposes only. If you require financial or tax advice, please seek a financial advisor or professional for help.
Yeah, get help.
Well, that
No,
sounds,
that's not us. Get actual help.
That sounds so like get help. But we do.
Yeah.
You need to seek a financial advisor professional. So that we've done that part. Cam. Anyway, we've done that part, so that's very important.
Cool.
Great. Okay, so today's podcast, what we'll be covering, we've got two wines that we're looking at. We have an Italian wine.
Yeah.
What's it called?
It's Fratelli Alessandria Speziale Pelaverga from Verduno in northern Italy.
I love it. And we got the second wine, which is...
Yep, so this is from Victoria. It's Best Great Western Young Vine Pinot Meunier.
Great, lovely. As you can tell, I did not contribute to the wines this week.
Just because they're weird.
Yeah. So if it's a failure, it's on you. No, I'm just joking. Usually it's half, but no. The next podcast, I will be bringing two of my little favorite gems, but we won't talk about them until last minute.
Sounds good.
But yes, they're on their way, and I'm excited. So that's what we'll be covering from a wine perspective. Yep. In terms of what we're looking at from an economics, markets, and the like. So what we wanted to go through is, I guess, what markets have really been doing since probably the last podcast, since probably the last couple of months. Month. And on top of that, just focusing a little bit more on, and there's been a lot happening with the US debt crisis. We have, what's happening with Australian property and interest rates around the world, but also interest rate expectations here at home. Or in Australia, but also, quite frankly, globally. And again, it's very different depending on the different regions, and that the R word of recession in the air. And we've all been talking about it, and obviously we wanted to really touch on that a little bit more. But to really start it off, we might start with the first wine, and then before we get into markets, and then obviously move on thereafter. Cheers. Ooh, that was loud, but that was good. So the first one is the Great Western, the young vine they call it, as you mentioned, the Pinot Meunier.
So this, for context, any of you listening have probably actually tried this already in Champagne. So it's one of the
champagne.
Yeah, it's one of the three main grapes that get made into Champagne, which are Pinot Noir, Chardonnay, and this little gem. So Bess actually have some of the oldest plantings in the world. So even though this is called the young vine, the actual vines, the vineyard was planted in the 70s. They also have a more expensive extra one called the old vine, which, depending who you ask, might actually be the oldest Pinot Meunier vineyard in the world.
What are we talking about? How many years?
In the late 1800s, so over 1,000 years. Over 100 years old.
Wow.
Which in viticultural wine terms is quite ancient. And people are cracking those open after 30, 40 years, and they're still
fun.
Yeah.
Wow. Are they being used in any way for champagne production, or no? They've been specific.
They might do a sparkling one, but historically they just do a still version from these guys.
That's interesting.
And so really what you should expect this kind of wine. You are seeing a few Australian producers make it as a single grape, a single wine. To me, it's quite a lot like Pinot Noir, but often, depending who's making it, it can be a little bit more on the graceful, elegant side, quite light on its feet.
Okay.
Pretty red fruit, like floral perfume, like just really easy drinking. And this is from a cooler part of Victoria, so the actual alcohol's not particularly high. I think it's 12 something. So
12%.
yeah, so it's something that you can maybe have it a little bit cooler on like a spring day, or even as we're heading towards winter, it's quite a nice style of red to enjoy. Even it can take some meat and that as well. And I just wanted something that's a little bit intermediate. We can get to more full-bodied reds as the temperatures cool down a little bit further.
No, that's interesting. It's got a bit of like a cherry sort of dark, fruity sort of taste, which is nice actually.
Yeah, cherry, strawberry, cranberry, sometimes depending on the acidity. But that's kind of what you should pick up.
And for those who can't see the colour, it is very light, almost.
Not quite translucent.
Not quite translucent, but like a light red. But putting it on a white on a white piece of paper, you can see that it is very.
It's very pretty.
Yes. But no, that's fantastic. Okay, well, we've covered the first wine. Now let's talk about, I guess, what we've been seeing in markets to date. And it's actually quite interesting. I was looking at the chart of the S&P 500. You know, it's 15% off its all-time highs, where we've come from last year to now. That's amazing.
Yeah, and interest rates have only moved in one direction.
In one direction, and you had tech really start to become market darlings in certain periods of the year. That's interesting again.
No, tech is hot again.
Hot, yeah, tech is hot. There you go.
You only have to look at, some of you might have heard of Nvidia, which does some of the GPUs that are
the best graphics cards in the world.
Yeah, but they're seen as being key to fueling this sort of AI revolution, if you will.
Well, they fueled Bitcoin and crypto mining. They fueled, and that was the hot ticket. They obviously been fueling, game console production,
and now it's AI.
Supercomputers, and now it's AI. So
I mean, if you just look at Nvidia alone, it's one of the, I think it's in the top 10 as the largest companies in the world. By
Nvidia, is it Radeon is the other competitor?
Yeah, but they're nowhere near as,
Nvidia has taken
scale. And Nvidia this year alone, just because of the hype, people are getting super excited about Chat GPT and sort of tools of that ilk. And Nvidia has added a couple $100 billion in market cap this year alone, calendar year to date. So since January, that's just to give you a sense of just how much hype there has been.
But the difference has been, the discussion before that was, are they going to be here or around if companies like your Googles and whatnot started to insource some of this production? That was a big worry for Nvidia. And now they're back in the forefront of this
to an extent,
AI
I agree with that. I think the other problem, though, is those other companies, you're buying a lot of the other stuff. Like if you click buy in your brokerage account, you're not just buying Alphabet's AI capabilities such as it is. You're buying their search franchise, which is very sensitive to the global economy.
And it's a ChatGPT.
And it is in ChatGPT.
It's sensitive to that too. Potentially a risk. ChatGPT is a risk to search engines.
And other kinds of businesses as well. So you've seen some of these online education providers in the States. So Chegg, as an example, amongst others. Now, these are smaller companies, so they're typically even more sensitive to changes in investor sentiment. But yeah, you've seen some of those stocks fall like 20-30%. People are like, ChatGPT is going to destroy their business. That might not necessarily be true in the short term, but because these companies are so illiquid, it doesn't actually take much for the share price to absolutely tank.
Yeah, wow, interesting. Well, to be honest, in terms of what else sort of we're seeing, obviously saw Microsoft's purchase of more gaming platforms are Activision.
Well, that's been contested by the regulators.
No, I think it went through as of this morning.
For the UK?
The European Union.
Yeah,
maybe not
the UK's... It should go through because the actual grounds, at least the UK one, are pretty laughable. But no, I mean... If
There's a
you
lot of
wanna,
consolidation,
yeah, if you want to
essentially.
paint broad strokes, it's like tech is hot again. Is basically the label for 2023 so far. And you've seen a lot of tech stocks like Apple, Microsoft, Alphabet, Amazon just rally quite hard. And part of that's justified on performance to an extent. I would say like a number of them have beaten earnings expectations. So that's what, analysts in the market are saying. This stock should deliver X amount of dollars for the quarter. And when companies beat that, usually they get a bit of a share price pop because they're like, oh, it's going better than expected. Happy days. But honestly, it's quite a mixed message you're getting from markets in some sense, because usually, in the US, your cash rate there, for those of you that don't know, we're talking in the low fives now. You can get,
Yeah.
you can buy like US government short-term debt in the low fives, and that's in that sort of environment. I have to ask, like, if I've got money and I'm like, where do I put it? If I can just get 5%, just having it sit in the bank or a money market fund or something like that, like usually in that environment, people demand a lot more attractive valuations from their shares, and that isn't happening yet.
But that's also caused, I think, as a tangent now, in terms of moving on to that sort of debt crisis that we've sort of got here, but also what's been happening with some of the banks. No one would have predicted, and it was almost like a blimp on the map.
Yeah.
Where Credit Suisse just disappeared overnight, and markets didn't really react to it. It just happened. Oh yes, there were small reactions, but nothing to like what we saw during the GFC or anything like that. You've had, First Republic. You've had all these, for all intents and purposes, they have collapsed. Even though they were bailed out, it's still a collapse in a sense. It needed to have that bailout. Is this becoming a more systemic problem with the banking? And let's separate it. Obviously, Australia is a very different beast to that of the US to a degree. It's not saying that they're obviously they can't, this won't affect them.
Yeah.
But is this? Are we going to see more in the US potentially more problems around this space? Is it contained, or is it? That's the question.
The way things are set up in the US, it still doesn't look 100% contained. There is still sort of fringe banks or banks that. So for context, to just give a very, very high level summary of the problem, a number of US banks were, in the smaller side of things, were a bit loose in terms of how they were regulated. And so what a bunch of them did was basically buy a lot of bonds that were yielding like quite low during when interest rates were a lot lower. And what's happened since interest rates have gone up a lot, they're suddenly sitting on these assets. It's like they'll still generate return, but because interest rates have gone up so much, they're now worth a lot less today.
And not paying out potentially the return that you require.
Yeah, and so in that scenario, if the bank is forced because people are withdrawing money, if the bank is in that sort of position, you can have a scenario where you see a real bank run. And so things like Silicon Valley, they were seeing tens of billions of dollars a day exit the door as the venture capital industry fled, right? So while that sounds all scary and the like, I would say you kind of have to quarantine it to an extent. So what I mean by that is, and what looks like happening is, the big banks were a lot better regulated, so they didn't have anywhere near the same issues, and they also had a more sticky deposit franchise. So problem with Silicon Valley Bank is they cater to the VC industry, but the problem with Silicon Valley Bank was they catered to the VC, and those guys, the early stage companies, they don't make money, they need cash. So even though Silicon Valley Bank saw like quite a lot of cash during with government stimulus and the like, that was hot money, and it wasn't going to last. And so they really mismanaged that asset liability risk, so interest rate risk, if you will. But So.
But what we're talking about here
Yeah.
is the 16th largest bank, and quite frankly, the others
Yeah.
in the top 10 as well. That's
And-
still not to be laughed at. Potentially, when you're looking at this, they're quite huge institutions.
Look, the US is a lot.
And yes, they have a history of
But the US is very different
fringe
to our market.
banks falling.
In Australia, we're used to the big four. And the US had way too much, well, arguably way too many banks for an economy of its size and scale. Arguably, this consolidation is just sort of the logical endpoint to all this regulation and the like. And so, if you talk to the equivalent of APRA over there, the idea of big, boring, stable banks that aren't going to collapse because they've mismanaged their deposit outflow risk, that gets them pretty excited.
Yeah.
And look at the latest news. JP Morgan, they bought one of them. It's like Jamie Dimon made the offer earlier, and they were like, oh, we don't want Jamie to get another one. And you know what? At the end of the day, he got it. It just was a long, winding saga.
And potentially for a cheap price.
Yep. Yeah. He, from what I saw at least, it looked like a pretty sweetheart deal.
He's good at those deals.
Yeah, very, very much.
Say what you will about Jamie.
Yeah, if we were to sum it all up, it's like it's a concern, but I would say the negative consequences of it are more, okay, it reduces banking competition in the States, which isn't ideal. Like for the average consumer, that's not great. In terms of it being a bigger risk, I would say that seems far less likely. Like
it's far less likely because you will have, I know it's terrible to say, but taxpayers will just foot the bill. And that's what's been happening. They foot the bill, they bail them out. Can this merry-go-round continue is the question. I think that's probably the broader question. And most likely it will continue.
Yeah, I think so.
Because the alternative is much worse.
Yeah, I think
potentially
the only saving grace will be whether we see a bigger push from sort of politicians and the like to say, damn, it's like we didn't see the Fed hiking rates having this unintended consequence of destroying competition in the US banking system. We don't seem to be at that point just yet, but it could happen. Like you are definitely seeing quite a bit of a divergence there, so it'll be interesting to observe. But I would also say, just to cap all this off, it's one example of how equity investors, people that hold the shares of these companies, just how delusional some of them were. Like for context, like people were a bit worried about Silicon Valley Bank. Even over the course of all of last year, the shares sold off quite a bit as people looked at, oh crap, all these VCs are burning cash and they're withdrawing money, and your franchise doesn't look as hot anymore. So that was all of last year. This year, you had people think, oh, Fed pauses income, and Silicon Valley Bank shares were up 50%. Like people forget that. They're now of zero. Like you didn't get anything. Like it's all gone.
It's gone.
But that just gives you a sense of just how short term and short-sighted investors can be.
Well, speaking of the US politicians, the US debt crisis, currently the debt ceiling issues regarding lifting the ceiling. To be honest, on that front, my belief is that it doesn't matter which side, and yes, there's movement before each side and potential for the US to default. I don't think either side wants the US to default on their obligations. And whether we like it or not, there'll probably be a deal struck sometime soon to lift that ceiling, potentially.
Yeah. But, okay. Yeah. So, let's just take it back a step. So, what's the problem? So, the problem is the US uses debt to finance government operations.
The interest on their bonds.
Yep. So, they issue bonds to finance the general run in the government, right? Now, the problem is they've legislated, they didn't have to do this, but they've legislated limits on how much government debt there can be. And so because they've done that, even though they didn't have to, like it's not a constitutional thing or anything, they didn't have to do it. So it's this whole exercise is just this elaborate own goal and just absolute stupidity, quite frankly.
You don't think there should be accountability on how much debt gets issued?
It's all for show. It is. This is really all for show. But I would say what happens for people that don't know is like periodically every, 6-7 years, because we had it under Trump, we had it under Obama,
Correct.
Now we have it under Biden. You have this big brouhaha where the opposition party, in this case the Republicans, is playing hardball about like giving the Democrats the votes they need to raise the ceiling. We had the opposite scenario under Trump, and we had the same sort of scenario under Obama. Under Obama, it was, I'd say, probably more noticeable because the government actually did shut down a bunch of services. And
they did shut down, but also, I think it hit probably the media the most during that period. Of what happens if it continues? Yeah, but it's an interesting topic because we've had this topic in the office. I think someone proposed, why don't they just shut down a few government agencies that don't do anything? And obviously, it's not easier said than done.
Yeah, I think, look, I think the reality with it is it could have some short-term impact on the economy and share markets, bond markets, as people get a bit skittish and are like, oh crap, maybe the government will actually default this time. And then you could see like a little bit of a relief rally as well, because usually at the end of the day, it's outside of there are a few people on sort of right that probably do want to see a default. Outside of that extreme fringe, I would say most want to see some kind of deal. It's just a matter of like how much blood does one side want to extract from the other, particularly in this case the Republicans hold the leverage. So it remains to be seen how that will play out essentially. But I wouldn't be overwhelmingly concerned. Like, I mean, look, if doomsday scenario does happen and the US defaults on its debt, it doesn't really matter what you're invested in. You're going to lose a lot of money.
People will get hurt. Yes.
Yeah, people will get hurt as well. But there's
shockwaves across the world.
There's not really a lot you can do to offset that risk, and it's I would say it's mostly counterproductive to really attack that. But in general for markets, you're still getting mixed signals. So it's like usually in this scenario, shares should be a bit weaker because you actually have an alternative to investing in the stock market. You could just leave your money in cash. And I got a notice from Nubank today. Your cash rate's up to 4.75% now.
But even some of the TDs that are coming out, even some of the, to be honest, there's even been hybrid issues that have been quite attractive. Some bad, some are good. Obviously, from the banks, there's obviously TDs that have come out that have been quite reasonable.
Term deposits. So you lock up the money for 1 to 5
There
years.
are options, that's for sure, that for the first time cash is actually yielding you something that's probably, from a risk perspective.
Cash is giving you a high yield in the share market, which hasn't been true for a very long time.
But it's interesting. And it probably leads us, to be honest, because we'll be focusing a little bit more on the economy, the R word, and rates and whatnot into the next section. But we'll review the Italian wine, I think, this time. So the second wine. So let's have a rundown.
You're going to get... Okay, so this is the Fratelli, Alessandria, Speziale, Verduno, Pelaverga, also 2021, so same vintage as the Pinot Meunier. This one, I have to admit, my 2 cents, I was actually really excited to get Dan to try this because I really enjoyed it when I had it with burgers, I think early in the year, and I liked it so much I got another two.
Quick question. What burger did you have? That's important.
It was from Vic's. I think it was. I'm pretty sure it was Wagyu or Angus on potato rolls. And I did my own like little burger sauce. Then I mocked up. So
I think that we'll have burgers the next time, and I'm going to have a naked burger. For those who don't understand, naked burgers are better than normal burgers. So essentially, it's a lettuce bun.
It's a crime
delicious.
against burgers.
Absolutely
It's a crime.
Delicious. But
It actually hurts to watch.
I know it hurts if it's
someone
like,
eat it. It just looks so wrong.
but it looks like a proper thing. But anyway,
If you're having bok choy, I could understand it, but like
no, even that's amazing. See, it's all amazing.
Oh, Central House, sorry.
Yeah, Central House, yes. But let's try and cheers to this one.
Cheers.
Cool. Oh, it's a little bit better now.
Yeah, so it's better, but it's not as for me. It's not as vibrant as the one I had.
A peppery,
earlier.
spicy sort of.
So that's the thing.
wine.
So Pelaverga is a grape that almost went extinct, and there's not a lot of it made in the world.
No, sorry, that's a bad joke.
So harsh. No, so what it's meant to be is like super bright, like quite refreshing, high acidity, red fruit, plenty of pepper, and just really fun. You can chill it a little bit, and like it's meant to be, a perfect smashable wine.
Well.
This one isn't shown. It's better with a bit of a chill, but it's not quite shown as good as the one I had early in the year. Which
Actually, leaving it
yeah,
has actually improved it.
yeah, the air helps, but it's still not.
But in terms of
Like I
was expecting,
I don't want to give the impression I'm a closet alcoholic, but I could have almost smashed the whole bottle myself when I first opened it. I'm not as hyped for this version.
don't want to share that expression.
No,
I'm just joking. Just alcoholic? No. It's just I can tell. Like there are some wines when you drink them, you're like, wow, I'm thoroughly enjoying it.
Yeah.
Just the wine.
Yeah.
And I get that.
It's nice, but the Pinot Meunier is showing it up tonight.
But it could be what you were eating it with, the flavors.
Yeah.
There's a range of things that usually determine that. Like when I first tried that, what was it? Not even 40 minutes. 40 minutes ago. Not a fan.
Yeah.
Trying it now, I'm like, I actually could continue with this. This is actually not that bad.
Yeah.
It's still light.
Yeah, that's the other reason. It's light. It's I wasn't trying to go for 14 and a half, like a typical Aussie Shiraz style.
13.5% alcohol. Yeah, it's not bad.
Yeah.
But
something different.
If I had to choose between the two, well, I'll reserve that towards the end.
Yeah.
With our rating.
Of
system.
course.
Anyway, so no, that's good. That's good. So we'll move on to the economic focus in terms of moving away from the wine. So Australian property and rates. With the Australian property, I have to say, now this is interesting because I had a chat with someone over coffee this week. Yes, this week. It's only the start of the week. Anyway, God, it feels like forever.
We're recording on the 16th of May. 2023.
Yes, a Tuesday. It's been a long 2 days at work. Anyway, on that front, I had a chat with someone. He was talking to a number of buyers agents, specifically around probably wealthier suburbs in Sydney. And when I'm talking about the wealthier suburbs, I'm talking about house prices or houses that would have gone for 6, 7, 8 million. Like they're expensive. Yeah. They're massively expensive houses.
They're a bit extra.
Yeah. I know where this is going. Anyway, we'll get to that in the end. But extra, please. It's probably I won't even go there because it's recorded. Anyway, so essentially these places, and this is really interesting. The buyers agents were saying that they're getting more and more bank foreclosure sales. So people are still buying them at $6 or $7 million, but it's because the bank is selling them. Okay. So people obviously couldn't service the loans, and the bank is selling them, which is really interesting and also divergent to other parts of Sydney. What you were saying with
like
family.
I had family buy in Western Sydney, and it was very hot. So like there was a lot of demand for sort of houses basically, so you could live with a family.
But what you're looking at is you're comparing $1 million loan, so to speak, with a $6 million loan.
Yeah.
Give or take, that's like a difference of $5,000 a month to service, with something that's probably over $40K a month
tens
to
of thousands
service.
of dollars.
That is ridiculous. Even on combined salaries, even on if you're renting it out, it's expensive.
Certain parts of Sydney are just
what
offshore investors. Frankly.
But essentially, what's really and obviously different suburbs are experiencing different types of changes. And I know we were talking with friends. He loves his property, him and his wife, and they were saying that there are still deals around that are really, really great, but then some that they look at and go, I wouldn't have paid that. Which obviously that shows that still people are cashed up. Maybe borrowing amounts have plummeted, but there are still people that are cashed up. So that's the property sort of part of it. We talk about rates. Well, the RBA potentially, depending on what comes out this week, and we're looking at what wages
tomorrow wages drop,
and then it's unemployment numbers
later
Thursday, I think. No, I think.
It's
Thursday. It'll be Thursday this week. So when you look at
WPI,
correct, So when you look at that and you're like, okay, well, if this whatever numbers do come out, this might signal to the RBA another potential hike. And I'm thinking the rhetoric is that probably will hike depending on what comes out. And so if we're saying
whether or not they should, is a different question.
Well, that's the other question. And then when you really compare this and you start looking at it, and you're just like, okay, well, it's funny, the expectation, and I had a lunch today with a number of CIOs at family offices, and look, we're all discussing and looking at this and saying, well, what's really fascinating is the expectations from the market is that rates will this year start to come off. But when you talk consensus on the table with a number of these people, no one thinks that rates will come off until next year or late next year. So they might be held for a lot longer. And mind you, the other aspect here that no one's really factored in has been, what if we have a hold of rates and then all of a sudden we have a spike? Another minor spike, or what has been priced into markets. Obviously, markets that are priced in a certain amount of cuts in a certain period. What if we have to unprice one of those cuts? That is obviously going to be very negative to markets, very negative to just the general, conception of the psyche.
Markets can still, so contrary to what I said before, markets can still go up in a higher rate environment, but they need to believe the growth. They need to be confident about the growth profile of the stocks that make up the market. If they're not, eventually that relationship will break down and you'll see shares sell off. Look, it's quite tough. I think in terms of the RBA and what they're going to do, look, my personal view is there's enough weakness starting to appear in the economic data that they could get away with just pausing for a few months. I honestly think that, and just seeing how the chips fall down. And then if it's obvious that in their eyes demand is too high, then
But the problem with that is that's all good and great. But what if we make inflation stickier, more ingrained for a lot longer? That is the risk. That is the warrant that they have.
That's their argument, I think,
and it's a real argument to have to a degree.
To an extent, I think my challenge with it is like how bad is it really? How bad is it really for wage growth to be a bit above inflation? Like, I think there's this misconception from business and whatever that we can't handle it. Well, if you look at the economic data, like something no one's talked about is like wage growth, sort of real wage growth, has actually been pretty dire in the last few years. And realistically, what we're talking about for some of these sort of wage increases is actually just clawing back some of the damage. Like, I think people have some pretty, in my opinion, some pretty serious misconceptions about wage growth and what can be tolerated. I mean, I look at the ASX and like, tell you what, most sectors, a lot of companies are enjoying, if not quite record profit margins, like near enough. And it feels like people have this real misconception. It's like, you know, at the end of the day, money can go to labour or it can go to capital, right? We've had a period, I would say, in recent years where, you know, businesses have leveraged their pricing power pretty well. And that's not been talked about as a driver of inflation at all. We're talking about, oh, we're worried about wage growth and this and that. I'm like, what about the fact we've got oligopolies, monopolies, and they're able to hike prices with impunity?
Yeah, but with the wage, who's actually getting it? That's the thing. Like, even if it was there, how is it fundamentally? You just can't just say, hey, here's everyone a wage increase. How does it work?
I'm talking about in aggregate, right? Yeah. Like, I think in aggregate,
and wages
people are underestimating just how worse
there has been
the average Australian.
There has been a labour crunch in a way where people have been leaving businesses to go to other businesses and getting paid a lot more. Is that a mechanism of wage inflation? Or is that more of a mechanism of there's a lack
to an extent, right? To an extent, but what I would say is, like, there are a lot of pressures sort of flowing through the system, and like, if you look at what drives what things make up inflation today, you fast forward 6 months from now, even if the RBA just held flat, like, it needs a pretty rosy backdrop for inflation to actually have accelerated from here. And the reason I say that is we're rolling off some periods where, like, you still had goods price inflation, you still had energy inflation and the like. Some of the stuff announced in the budget that people have said, oh, it's inflationary. Some of it's actually going to be deflationary because of how inflation gets calculated. Because it's not like, here's $100 that has to be applied to your utility bill. No. It's we're taking $100 off your utility bill. So that's something that's going to lower the cost of electricity, as an example, right? Yes. That will be a deflationary impact, even though it's not, I don't think, discussed enough out of the budget for it. But yeah, if I had to summarise my view, I think there's still a reasonable chance, given how the RBA has changed tact pretty quickly. I would say we're the reason we're doing this, the sky's falling and this whole about face is, like, suddenly, I was reading the RBA minutes today, it's like, so what, asset price inflation's a more serious consideration? And you read their announcement early in the month where they did hike rates. Oh, we're really worried about services inflation, even though the actual inflation print was, you know, it wasn't great, but it wasn't. But it was. It wasn't a major acceleration or anything. Correct. And so there's a reason people are running with their hands in their head, like, confused by the RBA, because the RBA itself isn't giving, to me, really, and plenty of others, really clear guidance about what they care about. Based on what the RBA had said up until early this month, people thought rates were going to be flat. And then lo and behold, the narrative changes, and now, UBS, others, like, we're going to have 2 or 3 hikes still.
But the conversation around this is, the RBA is saying one thing. I get it, what you've been mentioning. But the other thing is, when you're looking at this, it's also what's been printed in the media and what the focus has been. The focus has potentially been wrong, where maybe not every fact, and even, like, if you look at the budget, you would have said there would have been focus on very different things, like stage 3 tax cuts, when we should have been focusing on other things. in terms of not necessarily it being passed or being left. What I'm talking about is what was the other crux, like as you mentioned, the utility bill sort of thing. Why wasn't that talked about a little bit more? Little things like this that could have potentially, that changes the concept.
I think the reason why that stuff wasn't discussed is because what the RBA did and the extent to which it shocked the market, it shifted the narrative, and and I think that the great irony of all this is, and it's something that's not been focused enough on. But right now we're talking about inflation. Oh, crap! With inflation, it's coming. It's really scary. You actually look at what the consensus, the RBA, Treasury are all forecasting for next year, and even for the rest of this year. It's actually a pretty crappy economic picture. And what I could easily see us talking about this time next year is like, why hasn't the government done more to help growth? Like, you might laugh, but I think there's a really reasonable chance of that being the case. It's like,
well, you might not want that.
And
it probably leads on to the R word, which is recession. There's a possibility that Australia potentially avoids a recession, given our economy, given that potentially we might leverage again and maybe get away with it. The commodities.
No,
but in general,
just population, because we've ramped up migration. We had the update for March/April, and we're going great guns in that department. And for context, like, you can think of your economic growth as being sort of growth on a per head basis, and you can see it as growth on a just population growth as a driver, because you pump more people into your economy, you're going to have more demand for goods and services. The overall pie expands. It's the general idea. And that's what we're doing right now. Like, we have, some of the highest population growth rate in the developed world. And when you lay that on, like, it can be you actually need a pretty nasty hit to the economy to fall into a overall recession.
But if we talk about the US and Europe, I think Europe probably in a lot more of hurt. So recession will be much tougher there.
No, Europe's already flirting with recession. Some parts of Europe, I'd actually say, are in recession or near enough.
We have the US. I think they probably wouldn't. They can't avoid a recession. How bad it is the other question. Yeah. And maybe it's as we spoke with managers back in October last year in the US, and they said we do see a recession. We don't see it as bad as potentially what Europe might go through. So this is interesting.
I think the challenge is like,
and Australia potentially continues being the lucky country that avoids recession.
Yes and no. There is a cost, even though no one talks about it, to the economic model that we have, and you see it in, like, you don't invest enough in infrastructure. So anyone who lives in Sydney or Melbourne especially can probably attest to, you rewind 10 years ago, damn, traffic was a lot easier and we had less motorways and everything else, but traffic was a lot easier. Why has it changed so much? I mean, I'll give you 2 seconds to have a think about that.
Yep.
So, like, there are costs to the growth model we employ, and I think it's the issue I have with all this, and it's something that doesn't get explained well to the public. The economy is super complex. We're talking about the relationships between you, me, businesses, foreign concerns. Like, you try and summarize that all up, it's pretty bloody complicated.
It's very complicated. It's
really the story of our society. Now, the reason I bring up that idea is, like, it's really hard to know when we use a blunt tool like hiking interest rates. Have we gone too far? Because the problem is the damage and the inertia we won't see until much later. And that's personally one of my real concerns. Like, when people talk about, growth, we might not have that bad a recession. It's like, we've talked about this idea. You go back the last 30, 40 years before either of us were born. People have talked about achieving a soft landing. Didn't really stick the soft landing that often. You could maybe point to. I'm just trying to think one example in the 90s.
There's this discussion of everyone's like, it's a soft landing, it's a soft landing, it's a no landing, it's a no landing, depending on the environment. You saw what happened in the US with the First Republic, UBS, with Credit Suisse, and you're like, when all shit is hitting the fan, it's this is a hard landing, it's a hard landing. When things are okay or looking like they're okay, it's like it's a no landing, it's a no landing. It's funny how the conception is constantly changing.
Yeah, fair enough. But just conscious of where we're at. I think what I might end this one on.
Yeah, just that's
okay. I'll give my 2 cents. I think. I think. No, I think with respect to the RBA, there is a risk of more hikes. It's really hard to gauge where they'll go because they have not been very good at telling us where their sort of like red line moments are exactly. I think there is economic damage already showing through in Australia, certainly in the US, absolutely as well. So I think I would be very surprised if we're talking about rate hikes this time next year.
Yeah,
I would say that there might be some scope for a little bit more, but the end is closer than not.
I think it's probably they hold for a lot longer. I'm still worrying, depending on what happens, we just don't know. No one knows. There might be a scenario where maybe there is a hike just to control things. We don't know. And quite frankly, it's still watching this space, really. And in terms of the recession front, I think it is leading down that path, so to speak, in terms of the slowing. But again, we will continue to sort of see that as we see, I guess, the months roll through what these interest rates have been doing. And in terms of the wine, in terms of which one I preferred, it had to be the Great Western.
Yeah, the
Aussie one.
Yeah, the Aussie.
The first one.
I don't know. I was just trying to think if I had to score, it'd be like maybe almost 4 out of 5. The other one is probably closer to 3.5, 3.6 on tonight's showing.
See, on the Great Western, that's a buy. The Italian one, I'd say, is a hold, but it's not bad.
I think it's also just a joy. So, do you have a screw cap or do you have a cork? Maybe it was that because
what happened with the cork?
Pretty well, so I'm a little bit disappointed. I'm not gonna lie.
The Italian one, just for summing it up, the cork went straight through. So
that might be user error.
It could be user error, but I swear it wasn't me. But anyway,
it's all right. We'll get him a corkscrew next time.
That's it. Thank you, everyone, in listening in to today's podcast. We'll be back, and I look forward to talking a little bit more about the current environment, markets, asset classes, which we'll probably look at, and obviously and 2 new sets of wines. So thank you, and enjoy. Be safe.
Stay safe. Cheers.
Bye.